Hey everyone, Steve here, the Seller CPA, your e-commerce CPA. Today what I want to talk to you about is maximizing your business deductions for your income tax return. Well, the first thing is keeping track of your business expenses. Well, you might say, Steve, that's ridiculous, and turn off this video right now because that's so obvious. But hold on for a second before you leave and let me explain why. So I've been reflecting a lot on how I get new clients and the past tax season. And a lot of clients don't do any bookkeeping throughout the year, and they just catch up at the end of the year or bring all their bank statements and receipts to a CPA and expect them to produce a great tax return that captures every deduction. But do you think that if you're looking back over 12 months, you remember what all the expenses are and you're not missing anything? Better yet, do you think that the CPA is going to be able to tell you if you missed anything? Well, very likely not. So if you're not doing any monthly bookkeeping to keep track of your business expenses, then most likely you're overpaying your tax and you're missing deductions. So if you want to keep track of your expenses monthly to make sure that you're not missing anything when it comes to year-end tax return prep, how do you actually do that? Well, what I recommend is QuickBooks Online. Why? Because all of your bank accounts and credit cards that you use can be connected to QuickBooks Online, and every single transaction can come directly through QuickBooks Online into what's called the bank feed. And it requires you to then categorize each transaction. So every single transaction that comes through, you'll have to say what it was for. Now, in addition to categorizing the transactions, each month you'll have to reconcile to the month-end statement. Now, you'll get a bank statement each month from your bank or a credit card statement from your credit card issuer or bank, and it's going to be a PDF, and it's going to say the statement ending date is this date and the statement ending balance is this amount. And then you enter that into QuickBooks Online and you reconcile, meaning you check off all the transactions that were on that statement that were recorded from the bank feed to make sure that you have complete and accurate financials each month. And that's really the only way to make sure that you're capturing all your business expenses and ensuring that you're actually maximizing your expenses for your business tax return. So some people might ask me, why can't I just use something like Excel? And I do get people that provide me Excel spreadsheets, and I even provide an Excel worksheet or a Google sheet for people who haven't done any bookkeeping to kind of aggregate their expenses. And that method might kind of work, and it's something that you could do to get by, but really there's no guarantee that you're capturing all your expenses. Why? Because you're just taking data from somewhere else and entering it into the spreadsheet, and it could easily be misentered. You can transpose numbers, you can forget to enter numbers, you can duplicate things. There's no way to actually reconcile the data in an Excel spreadsheet to source data like a bank statement or a credit card statement. Now, if you're just getting started with your business and you really want to keep track of expenses the right way, you should get set up on QuickBooks Online. And outsourcing that might be difficult, but at least you can categorize all the expenses and make sure that you're not missing anything. But when you get to the point where you're doing, I'd say, at least $20,000, $25,000 in revenue, when you can have the cash flow to support outsourcing, you should outsource that. And then you should get that monthly bookkeeping done for you so you can focus on the business. And then you can look at your financial statement sheet each month and understand, am I making money? And then come tax time, it's already done for you. So you don't have to worry about scrambling and pulling numbers together because you've already had your financials done on a monthly basis. And I mentioned earlier in the video that how I get clients sometimes is when somebody has been working with a CPA that's probably a local CPA that doesn't necessarily focus on e-commerce, and they're going to bring all their data to that CPA, whether it's reports from your selling platforms, bank statements, or whatever you have, and providing it to that CPA. And they're probably going to do an extension because you got the information to them and now they need to figure out what to do with it. The fact is that their goal is to just get the tax return done, and getting all this data into a format that can actually be put on the tax return is going to be challenging for them, especially if they don't focus on e-commerce. And so if you're doing monthly accounting, that changes everything. So if that's the boat that you sit in, where every year you dread tax time and you pull all your information together from your e-commerce business and provide it to a local CPA, they put your return on extension, and then you wait months for it to get done to find out whether you owe tax or whether you don't owe tax. And they ask you a ton of questions because they don't really understand it. And maybe you don't even know how to accurately answer their questions because you don't fully understand it. Your tax return result is not going to be very good. But what I want to tell you today is that's actually not normal. Like when you work with my firm, my clients get their financials delivered every single month, and they've been reviewing the financials each month, and they had a chance to review it and talk with me if they have any questions. So by the end of the year, they already really know what their profit was and whether they're going to owe tax or not. Most likely they've been making estimated payments. And there's really no stress during tax time because I already have all the information. So they are just relying on me to take the information that I've already been tracking, putting it into the tax return. And when they ask me, Steve, did I maximize my deductions? Did I get every deduction? I say absolutely, right? Because we've tracked those expenses every single day from all your accounts that you use for the business and recorded them properly. So you know you're getting maximum deductions. And so that's why I said, stick around to this video and listen a little bit longer, because you might think, well, yeah, tracking business deductions is obvious, right? But it's even though it's obvious, it's not something that everybody does effectively, and most likely they're missing or duplicating expenses, and that's costing them a lot of money in taxes. So let's say you've set up QuickBooks Online or some system to keep track of your expenses on a monthly basis, even if it is Excel and that's the best you can do, but you're doing something on a monthly basis. The question is, what can you actually deduct? And the answer is whatever is ordinary and necessary expense for your business. Now, what does that mean? Well, ordinary is something that would be ordinarily spent for that business type, right? So you know best what your business type is and what the ordinary expenses in that business would be. And necessary is also, you have a need to spend that money to do something in the business, right? So if the expense is not ordinary and necessary, then it's not necessarily deductible. Now, you can push the limit and say, well, okay, I'm running a business where I am producing fishing tackle and I need to go test that fishing tackle. So now I'm going to try to deduct all the interest on my boat loan because I bought a boat. So you can justify that in your mind, but just be aware that, if you ever get audited, the IRS can simply just say, we don't think that's ordinary and necessary, right? So be reasonable in the things that you try to deduct, because if you're unreasonable, the IRS will see right through that and they'll just disallow the deduction and then end up costing you more tax and penalties. Since I specialize in e-commerce, I just want to point out one thing, that inventory is not an expense, okay? And there's a lot of confusion about this because the Tax Cuts and Jobs Act of 2017, the TCJA, talked about treating inventory as something that could be expensed. And really what that means is if you are a company, for example, and you keep an inventory of supplies that is not the primary material income producing factor for the business, well, okay, maybe you can expense that now instead of each month making an adjustment to reduce the inventory of supplies that's used in the business. But in e-commerce, inventory is the primary income producing factor, and therefore you need to capitalize it, meaning Every time you make an inventory purchase, it goes on the balance sheet as inventory. It's an asset. It's not an expense until it's sold. When it is sold, the unit cost of that product should reduce inventory, and then you're expensing it through cost of goods sold. So that's how you handle expenses for inventory or cost of goods sold in an income producing business like e-commerce, where inventory is the primary material income producing factor. So if you want to get more organized and have a better result on your tax return and maximize deductions, just make sure that you're recording things on a monthly basis, preferably in QuickBooks Online. But if you don't want to handle it yourself and you want to have somebody else do that for you and take away a lot of stress during tax time, have us do your monthly bookkeeping, and you can just make an appointment at sellercpa.com for a new client intro call, and we'll be happy to talk with you. If you enjoyed this video as well, please think about liking and subscribing so that you can get one of my new videos that I'll be producing every week.